Welcome to TMS Insights. We're bringing you a wrap today on the just finished reporting season. February's wound up, it's now March. It's Ben Clark and Jeremy Hook bringing you the news of the reporting season. And overall, Ben, it was a pretty good season. There were more positive surprises than negative in total.
Yeah, there was, Jeremy, and for the first time in quite a while, we've seen some revenue growth across the broader market. But I would say, you know, in the blue chip area of the market, there were some quite good results, but in the mid cap area of the market, it was very patchy and some really bizarre share price reactions to some of the results. You know, in some cases, companies came out and delivered exactly what we were led to expect they would, big sell-offs, and in other cases, you know, slightly worse than expected news rises. It was a lot of volatility around the results.
It was, and it was overall a good one for the market. The index was up a bit more than 2% during the month, so it reflected how Ben said the better performed larger cap stocks were. Let's get into some of these bigger results, and why not start with the turnaround couple at the top end of the resource sector. Rio and BHP both produced stunning returns to form after a poor 2016.
Yeah, I mean, it's just incredible in such a short period of time. These look like totally different companies, don't they? And if you look at BHP as an example, the market was expecting free cash flow of 3.9 billion and they delivered 5.9 billion. Yeah. It was a huge beat on expectations. The irony is both BHP and Rio have pretty much fallen every day since delivering amazing results. Yeah. And that, of course, has been because there's been a bit of a pullback in the iron ore price, and I guess, you know, that relationship will always be there. But the companies are in much better shape than they've been in for a while.
And paying down debt, so the balance sheets are better as well. In the hospital sector, the leader there, Ramsay. Yep. Good numbers again.
Great. You know, another profit upgrade from Ramsay. I guess the disappointing thing from a shareholder point of view was that Christopher Rex, you know, is very well regarded CEO, has announced his retirement at that result, and that actually saw a sell-off on what we would normally have expected to see quite a decent run in the share price, because there was a profit upgrade from the company in those numbers. But to me, that probably looks like you know, a good opportunity. And Healthscope was another interesting one.
Well, we saw that at the other end of the equation with a profit downgrade in the back end of last year and the stock falling. We think now it looks pretty good value in the 220s, and that was a solid and very open report from Healthscope. Yeah. So some value appearing in the second largest player in the hospital listed space.
Yep, absolutely.
So that was good. Well, not a totally unrelated area, but Invacare, again, they announced just before the reporting season they were closing down their East Coast funeral services operations. But surprisingly, this result turned out to be a really quite good one.
Yeah, this was probably one of the better ones that we had, and the stock's almost up to an all-time high on the back of it. And probably what was interesting there was that they term them case volumes, which are, you know, the number of people who've passed away going through their network, actually fell during the half, but quite strong earnings growth despite that, which means, I think, much stronger focus on costs across the business, and this continued move to find more ways to make money out of funerals, etc. So still, I think, a great long-term
good
business.
One we've had for a while, so that's good. One we've also had for a while was Seek. Now, we always enjoy their conference calls at reporting time. This one was associated with clarification of their bid for Xiaoping, which was quite interesting, but overall good numbers from Seek as well.
Yeah, really. Look, and again, for the second time in the last two reports, the highlight was the domestic business, and we see long-term growth in the international business, but because Brazil and Mexico and some of these economies are not in the greatest shape at the moment, they've sort of, the growth has reduced there somewhat, but still long-term will grow. But the domestic business was great, and the big news was this Xiaoping. The Seek owns 62% of Xiaoping, which is the number one recruitment website in China. It is growing very rapidly, and they've partnered up with two of the leading private equity tech investors in China to make a full takeover bid for our remaining shareholders. The price looks very attractive to Seek, not so attractive to the Xiaoping holders. But if they've got control of the business, I guess that's the luxury that you get. Yeah. James Packer is the largest minority holder in Xiaoping. Yeah.
So we'll see how that goes. That was good news, though, overall. A couple of stocks which you'd probably say have been dogs over not only 1 or 2 years, but often many. QBE and Woolworths. They were back in town in the reporting season.
Yeah, QBE delivered probably the best result we've seen in 3, 4, 5 years, and So not only is operationally the business really starting to hit its straps, but also the bond yields, which have been a crimp on its earnings growth, are starting to rise quite strongly and become a tailwind in this environment. So, we had news that Allianz made an informal takeover approach to QBE over Christmas with a $16 price, which was talked about. And I think there would have been a lot of pressure on QBE to engage if they hadn't delivered a good result. But I think the market's pretty comfortable that stock's going to do well over the next few years.
It's fair to say, though, that there was no comment from QBE about that Allianz bid, which remains very much unknown what circumstances
in the media rumours and all those
Right, exactly. Now, on the another, that Woolworths I mentioned before, turnaround story of some note there, that was a really impressive set of numbers. Having been really bashed around by both Coles and Aldi over the last few years.
Yeah, and I think, that's the second successive positive like-for-like sales growth. So they seem to really have gone back to concentrating on what Woolworths was so good on in their heyday and getting great results. Brad Badaducci, the CEO's, under-promising and over-delivering. Yeah. And, it looks like it probably has got further to go because it was totally unloved. Like BHP and Rio a year ago, no one wanted to know about Woolies, and we all knew the concerns, but they're getting runs out of the business. Yeah.
And the printed circuit board producer Altium had a very good set of numbers.
Impressive. Great set of numbers. Probably a touch weaker than the market was hoping for, but maintained their full-year guidance and their aspirational 3-year earnings guidance. It's been this is the theme that we've spoken about at length on these calls. The high PE, high growth stocks have come under massive share price pressure. In many cases, not because there's been a change in the business's fundamentals. It's more this rotation of capital that's been occurring since Trump won and last year. But Altium, to me, looks like it's still got a great outlook.
Great business. Again, the market's decided it's just not prepared to pay up for longer term earnings. It becomes quite myopic at times, and it did that at the back end of the year and again the first couple of months of this year. Now, a stock which did it tough last year was Blackmores. We followed that one, and again on the call, the numbers this time around, not bad, Ben.
Yeah, definitely an improvement. So they had a terrible first quarter of sales, a 16% pickup in the second quarter of sales. So clearly demand is starting to rise again. It was a bit patchy. There's some parts of the result, particularly on the cash side, that weren't that great. And the market sort of took the negative view to it. But I think there are positives that you could take out of it as well. The main ones being that sales are starting to re-accelerate. And Christine on the call said that had continued into the current quarter. So fingers crossed that continues. But, I think quarter to quarter, half to half, this is a very hard company to pick what their numbers are going to look like. But looking further out, the growth looks good.
Okay, excellent. Now, one of the trickiest reports and the worst outcomes in some of the stocks that we look at came from Isentia, which has only been listed a couple of years, and it's by acquisition and then through its core business slowing in sales there. There's been some troubles at Isentia.
Yep, definitely. I mean, in hindsight, a high-quality mid-cap business that made a very bad decision to go and buy a relatively small company called King Content, and that has turned out to be, was meant to be profitable and also to accelerate the profits of the rest of the group, and is now unprofitable, and a lot of resources are being thrown at it. And I think what we've had there, Jeremy, is a combination of, 2 earnings reductions, which is never a good look, and then a big de-rating of the earnings multiple the market is prepared to pay. To the point now where I think we were looking at the numbers before this, and it's trading on 9 times estimated earnings for next year.
That's right, yeah.
Which would seem jaw-droppingly cheap, but the market's lost the confidence, I think, in the CEO, is probably fair to say.
Yeah, that's right.
And until that confidence is regained, and the only way that will be regained is through delivering on what he's told us he's going to do, then you'll start seeing normal earnings multiple applied and hopefully some recovery in that share price.
Yeah, okay. One that's been through the mill, Certex, again a tough year, so numbers weren't expected to shoot the lights out. But they've got a new CEO and they're approaching the market in quite a different way now. Yeah.
Look, they also reduced their sales volumes targets at the end of last year. the big thing for them is the trials. And I actually had a lunch with the company yesterday, and I'm going to put something together, with trying to educate. We were educated on what to expect out of the trials, and in turn trying to help clients in terms of what to expect. But look, it's still a growth business, but again, it was a surprise to the market when they downgraded their numbers, and we've seen that PE multiple reduced. But they actually have a very real near-term series of catalysts that could get that share price back up. But it is a little bit in the hands of the gods. These trials are impossible to predict. Although they are confident, you're only as confident as you can be with these things. Curing cancer isn't an easy process.
So it certainly isn't much to have. Much can go wrong and right in that area.
Yep.
So another, while we're looking at the stocks that have had a tough time of things through reporting, Vocus had a really strange and difficult end of 2016. But basically what they reported on was quite good, and you can see really the path forward for Vocus now. Yeah,
look, I came out of that call with a lot more confidence in the company, because what's interesting about this business is the market, with TPG as well, that didn't report in this earnings season, there's the worry about what the NBN means for these companies. The rollout of the NBN, does this create a big competition event? When you listen to the Vocus CEO, rather than being cautious about the NBN, he sees it as a massive opportunity. And in 6 months, Vocus has increased the market share in the broadband network from 5.8% to 7.6%. So they're actually gaining share as the NBN is being rolled out and making similar profit margins to what they were making previously. The next gen acquisition, I think they're still trying to bed down, but he seems more confident that that's occurred. So again, I think we've just had an earnings multiple derating, whilst there's these question marks. But there actually wasn't. That was actually, I thought, quite a good result.
Yeah,
I
agree.
And
you can see the way forward, which is important. Well, just bringing that together, it's been a reporting season which has provided a few body blows to mid-cap stocks, but a strong recovery for a lot of the leaders, and that's reflected, I think, through most of our portfolios, which is an overall good story. But guess what? There's usually a couple of things, and there are now, that we have to watch very closely. As we wind up now, also just to remind from that previous video that Matt Salmon and I did regarding the changes in super, do get back to us if there's any questions about that, or of course regarding stocks and investments more broadly. Until next time, that's the TMS Insights video today.